Hey, good afternoon to everybody out there. My name is Brent Moores, and it's time for Advanced Options Strategies. And glad you're joining me. So today, I want to talk a little bit about zebras. So we're going to get to that in just a few minutes, what they are, and I want to really focus on example trades here today on those. So we'll get to that soon. Let me mention a couple things. One, I'm joined by Mr. Cameron May in the chat. I've been working with Cam for many years. He's a wonderful educator, as someone mentioned in the chat there. In fact, let me just invite you on Fridays. The session the webcast that immediately precedes this webcast is called Advanced Charting Techniques. Check that out. Cam teaches that. I guarantee you'll love the session there. So you can follow either of us on X at Brentmore CS, at Cameron May CS for additional content throughout the week. And remember, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. The Paper Money software application is provided for educational purposes only. And it's a great way to practice, but just realize there's some differences there, including, hey, Paper Money doesn't assign short options early. That's just one example of some differences there. Schwab does not recommend the use of technical analysis as the sole means of investment research. I'm not going to factor in commissions in the trades we do, but just realize commissions and fees are a real thing you need to pay attention to. And let's see. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. We'll be dealing with some short options today, so that's a factor, no doubt today. There's no guarantee of an execution of a stop order that is going to be at or near the stop price. Okay, let's head on over to the Thinkorswim platform. This is the S&P 500. S&P 500 all-time highs yesterday in like everything. That's a slight exaggeration, but the major indices, including the one that has been lagging for a long time, actually hit an all-time high earlier today. We're off those highs right now. That's the Russell 2000. So that's kind of a nice, little cat. The Russell has caught up a little bit to a certain extent here to some of the others. There we go. So we're going to be talking about zebras. What's a zebra? Zebra is it's basically what we're going to be talking about is back ratio spreads. What's a back ratio spread? Well, when we say a ratio spread, we're doing a different number of long and short options. So a back ratio, we're doing more long options and short options. If you want another session after this one with a little more in-depth on back ratio spreads, I did one a few months ago. I just put the link in the chat. For those of you who are interested, it occurred on June 20th in the Advanced Options class archive, if you check there. And if you're going, what's a front ratio spread? It's a little different than back ratio spread. I did a session on that on June 27th. Same archive if you want that. In fact, what I'm going to do is I'll put a link to that for those of you live in the chat. You can do that. Otherwise, just go to the Trader Talks channel. And on that Trader Talks channel, you can find the archives of, just look for the playlists is basically how I'd suggest you look at that. Okay, so but just most basically, on the most basic level, a back ratio spread is we're going to do one short option. Okay, it can be a call or a put. Okay, so you can do a call back ratio spread or a put ratio back ratio spread, and we're going to do two or some multiple thereof long option. Okay, same expiration date. Okay, can be calls or puts. Of course, if the short is a call, then the longs would be calls too, or vice versa with puts. And that's what that is. And so it's going to be a debit spread, and they can be kind of expensive. we'll go through examples on those. But the key is you have more long options than short options in the case of a back ratio spread. If you want to be bullish, you're going to do a call back ratio spread. If you want to be bearish, you're going to do a put back ratio spread. And of course, if you're bullish, the risk is to the downside. So if I do a call back ratio spread and the stock goes down, that could be trouble. That's where the main risk is on that. And in the case of a put, if I do a put back ratio spread and the stock goes up a bunch, that's where the risk is. But I think I don't want to get too much into that right now. I want to just give you examples and we'll talk through some of those examples. How about? Okay. So what I was going to do is I'm just going to look at some, trades on stocks that we don't currently have trades on. Okay. And I was going to look at some companies that you're probably familiar with. Here's Uber. Uber has a nice little trend. We've broken through that 20-day or 20 days above our 50-day. Higher highs, higher lows. You could draw a trend line if you wanted, but essentially it's all saying the same thing. It's trending up. Doesn't mean it's going to continue to trend up necessarily, but that's where it is right now. So if we're going to do a bullish trade on that, let's look at it. I'm going to go to the Analyze tab here. I got Uber in. And I'm looking for a bullish trade on Uber. How long? What expiration date are we going to do? Well, it depends on how long I think it's going to go up. I can do it a very long period of time. But remember, just like with long calls, the longer you dated the option, the more time till expiration, it's going to cost you more. There's just more time value, more extrinsic value in these. And so that's they're just going to be more expensive. So what I'm going to do here is I'm going to just look at the Uber options, and I'm not going to go out super long term on this. When we go to add simulated trades, I'm going to go out to our monthly October 28th. So we're looking for just maybe like a 3-week trade here or something like that. That should be long enough for our purposes. Now, I mentioned kind of at the top of the webcast, zebra. Zebra. What's a zebra? Well, zebra just simply stands for zero extrinsic value back ratio spread. So they kind of it's ZBRA or ZEBR, zero extrinsic back ratio. Anyway, we call it a zebra. Okay. And so what I'm going to do here is I'm going to look at my I just added that extrinsic value column. Okay. You can look at calls, puts, doesn't matter. You can add that column, different ways to add it, but you can go right there, and you can add that column right there if you want on that. You just click on it, and one of them, right there. Okay. So there we can go. The way we're going to do it, though, for our purposes in this class, is we're going to make the short contract the at the money contract. Right now we're at about 98.66. So we're kind of right in the middle between the 97.50 and the 100 strike. So really you could do either on this. You could do either. Let me go to the 100 here, and I'm going to sell that contract. I'm just going to click on it, and that's going to put that in. I'm on the Analyze tab right here. And then what I'm going to do is I'm going to buy 2 contracts that are in the money. But let's look at the extrinsic value here. The extrinsic value on this is, on the $100 strike, is about 320. If I want to go down to and get it so that the extrinsic value is essentially close to zero, it's not going to be exactly zero, then I'd want 2 of these contracts to equal basically what the extrinsic value is here. Now, if I go here, 2 of those are going to be about $2.70. Okay. If I do 2 of these, it's about $3.60. So I can do either of these. If I go to the one that is a little bit higher strike, what that is going to mean is it's going to be a little less expensive for us. I'm going to do 2 of those contracts. So let's take a look here. Now, why are we doing these zero extrinsic back ratio spreads? If you do the zero extrinsic value, you're essentially, and we're not quite there on this one because it's not exactly there. Essentially, what we're going to have is we're going to have a break-even point that is where the current stock price is. That's what we want. That's our goal on this. The break-even point near the current stock price. So it doesn't even have to go up much to be profitable on this. Okay, let's take a look at the trade. Let me go to the risk profile. Let me go here and just look at this. Let's see, we're 17th of October expiration. Let me go here and here. We're going to put 18th of October in here. We're going to set our slices to break even. And there we go. So 98.78 is our break even. Let me just put the current price in there. And you can see there's the current price. Essentially, that's where we're at. If the stock goes up from our profit loss graph, it looks profitable. If it goes down, we're going to be losing money. That's how it is. By the way, there's a survey link in the chat. We appreciate your feedback on that. Okay, now, just because it's a zero extrinsic value trade or close to it does not mean there's no time decay on this. There is time decay on this. If I look at the current price, about $5.50 per day of time decay. Look at our profit loss graph. The higher the stock goes up, the more money we potentially make on this trade. Okay? The more the stock goes down, to a certain extent it gets worse, but then it kind of flattens out at expiration. But also notice that where we're currently at, that's the purple line, as opposed to expiration, there's a difference there. That means if the stock goes down, it doesn't mean we're probably likely to see a max loss if it goes down quickly. Okay, if it goes down the next few days, it's not likely we're going to be at a max loss scenario here. Let's take a look again at that chart on Uber. Remember, we're bullish on this. Well, when am I going to get out? If the stock goes down, if let's say if we break below this low, then at that point, it's probably looking like this trend, my hypothesis is that the stock is just going to go up from here. Maybe wrong. And so I'm going to just say, I'm going to exit if our stock goes down to, say, 91 or something like that. Now, let's look at this. What if it goes down to 91? Well, you're looking at this and you're saying, well, that's max loss. That is a max loss at expiration. Before expiration, that should not be a max loss, hopefully. So, but we're only doing this because we think it's going to be a trade that is a bullish trade. Now, maybe what I should have done is I should have done that trade on the trade tab just to kind of illustrate to you. If you want to analyze your trades and you put the trade in from the trade tab, and we said we were doing the $100 short call, and we were doing the 92.50 long calls, 2 of those. I'm going to hold down my control key. And let me just double check my quantities there. That's what it should look like right there. If you want to analyze this trade, even though you weren't on the Analyze tab, you can still analyze the trade. Just simply right-click on the line and analyze a trade. Now I think I have my other one in there right now. So let me get rid of, okay, I've overlapped. What do I got here? You know what? Let me get rid of these. Let me start from scratch here. Trade tab, I'm going to right-click, analyze trade. There we go. That's showing it. So you can see the same thing. This is just going to show the same thing. I'm not going to go over it again, but you can see the same thing based on starting from the trade tab. So um, that's our debit. So that's a $1,200 and change, $1,250 cost to the trade. Now, the cost is going to be more if you get a more expensive stock in there. And maybe later we'll look at an example of a more expensive stock. This stock's roughly in the $100 range. And so if you get a cheaper stock, it'll probably be cheaper. If you just strikes, it may be cheaper on that in this case. So there we go. And we know our exit. We said if it goes down to like 90, we're going to get out. Look at our chart. We said if we're breaking down below this recent low right here, we're going to look to get out of this trade. How do I do that? I'm going to create an opposite order. Just click on first trigger sequential, right click, create an opposite order. This one's going to get me out. I'm going to make this a market order. I'm going to make this good till canceled. I'm going to click on my gear and I'm going to say, I want to get out if Uber marks less than or equal to $90. Okay. Click my enter key, click save, and I'm going to click on confirm and send. Just make sure you read this over. Make sure you read the red line here. Make sure you realize max profit, it's unlimited. As long as the stock keeps going up more and more, there's only so much it's probably going to go up in the next couple weeks. We're also going to look to get out before expiration. Remember, short options can be assigned before expiration, no doubt. That certainly is a real risk. That assignment risk is going to go up as if you hold it very close to expiration. So with once we get under 10 days to expiration, we're probably just going to look to exit this trade at that point. We're not going to hold this to the last couple days. And so that's going to be, now, as long as the stocks keeps trending up and the momentum's going up, we want to hold on to, we're likely going to hold on to this trade until we get into that time frame. But if it starts going down, we can be a little patient, but we do have our exit in there on that trade. All right, so I'm going to send this order, and then let me hit up questions in the chat here, because Chris always has great questions, and we're going to look at those, but I'm going to look at another example, because I want to point out that you can do this in a bearish trade as well. I'm going to take this as more of a bearish trade, but let's take a look here. Brent, are there particular market conditions or other factors of the trade details that suggest zebras, or is this really another alternative strategy? This is actually a strategy that would work pretty much any time. When you look at the trade, when you look at that, in fact, let me go back to Uber here real quick, and then we'll get to Walmart. When you look at this trade here that we have on this, let me get rid of that. This is the trade that we have right now. If you look at the trade, I mean, we have two contracts of the long, one of the short. We are negative theta, we're positive vega. It's going to benefit us in a rising implied volatility environment. But the time decay is going to work against us. So yeah, rising implied volatility would be one market conditions, but I really think most market conditions, it's certainly a possibility there for you to consider this trade. This is not that dissimilar from just doing a long call, or in the case of a bearish trade, a long put. So the market conditions for a long call or long put are going to be fairly similar probably to the market conditions for this back ratio spread, would be my take. Now, you may be going on Walmart and saying, hey, this, for the most part, this has been going up over the last 6 months. Why are you looking at more of a bearish trade on this? Here's what my thought is. My thought is that we have a pretty significant resistance level right there at that, okay? If you don't think that's going to hold, you wouldn't do this trade, okay? Because I'm going to be doing a bearish back ratio spread. Furthermore, we did kind of test higher here, which was very nice, but by the end of the day, we had sold off pretty substantially. So we did test a break, and that breakout failed. So to me, that lends a little bit of credence to the fact that this may be more of a kind of a double top pattern here, maybe, right? With maybe this being a potential target area, okay? That was a crooked line, and do it there, okay? So Daniel said, on the other one, why did we set that stop there? Now, remember, at the max loss zone, if we held it to expiration, that was a max loss where we set that stop, okay? But we're not holding all the way to expiration. So I'm not going to say never. Technically, it could go to a max loss at that point. But if we're getting out with a week or 10 days to go to expiration, we're not going to be near that max loss zone. Why did we set the stop where we did? Because that was where we were looking at broken support. We were doing it based on the technicals of the trade. Similarly, if I'm looking at Walmart and I'm doing a bearish trade here, I'm going to say, look, I've got some resistance around 104. I'm going to base my exit based on that and say, hey, I'll give it a little wiggle room. But if we break above, say, 105, maybe we're going to get out of that trade in this case. So let's do a similar thing on Walmart, except, so a lot of this is going to be the same. We're just kind of shifting polarity on this. I'm going to the puts. I'm going to go to Walmart. Now, I'm not stuck on this expiration. Okay. I'm certainly not stuck on this expiration. I'm going to look at different expirations. Just be a little cautious when you're looking at these weekly expirations. Sometimes liquidity is a little less. And to me, the easiest way to check out liquidity is to look at the bid-ask spread across different strike prices. One trap that you can get into is looking at bid-ask spread is you can look at one strike, and you can go, oh, look, there's a nice tight bid-ask spread there. But it could be just kind of an anomaly almost. And if you look across the board, the others won't be tight, okay? In this case, as I'm looking at different strikes, it seems like we have a fairly tight bid-ask spread amongst a bunch of different strikes. That's probably a good sign. But if you look at that, that's kind of a good way to tell. A lot of times when you go to these weekly options, okay, a lot of times when you go to those weekly options, the liquidity, the bid-ask spreads are not going to be as good. All right, so just be aware of that. And to be fair, sometimes you go to the monthly options and the liquidity is not great either. So in that case, you wouldn't even do the trade at all. But sometimes there is the difference between weekly and monthly, and it may push you a little bit towards the monthly. I'm going to do weekly here. It's just going to be a shorter term trade because this really isn't much of a trend trade. We're just kind of looking for this to give us a pullback here, is the only reason we're doing this. Okay, so I'm going to do the same thing, same process. I'm going to go at the money on the put. Stock is at 102.5, we'll say 103. We're a little closer to that 103. I'm going to sell the at the money put. So I click on the bid price. I'm going to look at my extrinsic value. And let's see what our extrinsic value is. Our extrinsic value is 170. So again, we're not going to get there exactly, but I could do, say, 2 of these. That'll get us to about 190. So mostly 0 extrinsic value. If I want, I don't have to do 0 as extrinsic value, but if I do that, what's going to happen is my break even is likely going to change. So let's say I were to do the 101 strike instead here. Let me hold down my control key. I'm going to do that twice. Now, if I look at my break even, let's analyze this trade. See, October 11th, okay, that works. we're going to set our slices, break even. There's our break even on that. And where's the current price? The current price is there. So look, there's kind of this different, hold on, make sure I don't have any extra trades in here. No, that's all we got on there. In this case, because we didn't pay attention to that, there's a pretty good difference in our break even and the current price. We need this to go down a lot more. Now, it kind of helped because actually, if it goes against us and the stock goes up, we don't have as much risk on this trade. But this is a much more bearish trade that we need a bigger bearish move on in this case. What I think we'll see, if I do change this and move this strike down, let me set my slices again to break even, is we'll see. Hold on one sec. Did I do that right? Oh, I did my strikes wrong. So thank you. Let me redo this. What did I do? Okay, let me go back to our trade tab and see where I messed up here. So I went, I want to go at the money. Yes, I did. I went the wrong way on. That was wrong. Okay, I totally messed that up, folks. That was not smart. Okay. At the money, we're saying is 103. We're going to sell that. We're going in the money on those. I'm going to look at that extrinsic value, 169. We're going to go to about there, 105. That is where we want to go on this. And we're going to buy that, 105. I went the wrong way. I went out of the money on that. I meant to go in the money on that. So Chris said, shouldn't your long strikes be in the, yes, you're correct, Chris, on that. So thank you. You were not, and then you said something that is, maybe you're not understanding. No, you were understanding correctly. I just did it wrong. So let's analyze this trade again. We're going to analyze the trade. Here we go. And we're going to go October 10th. We're going to set our slices to break even. There we go. And let's just see where our current strike is. Right there, okay? By doing the zero extrinsic value, the zebra trade, you end up with your break even and the current price essentially the same. Okay? That's a difference, by the way, between this and just doing a long call. If you just do the long call, there's going to be a bigger difference typically between or a long put. There's going to be a bigger difference between where the current price is and where your break even is. All right. So in this case, they're about the same. My debit is 450 in this case. My exit, what did we say on our exit here? Well, we said if we break above this level, around 105, we're going to look to get out. So I'm going to do that. I'm going to look to get out at that point, about 105. I'm going to create an opposite order. I'm going to make this market good till canceled, gear, and we're going to put this in, and we're going to say if Walmart marks greater than or equal to 105, we're going to get out. Now, can you automate the time exit as well? You can automate the time exit. You know what I could do is I could say, look, this is going to be a first triggers OCO. Let me right click on, let me just duplicate this order. Now I have my entry order for this long put. I have my order to get out if the stock goes above 105. And Let me get rid of that. I don't want this anymore. Okay. I'm also going to get out just if we get within 10 days of expiration. Well, these were October 10th expirations, or we'll say a week till expiration. So we'll say October 3rd. So I'm going to say we're going to submit this on October 3rd. So on October 3rd at 12:29, that's my time zone, by the way, this order is going to submit to get out of this trade, and it's going to just get us out at market. What if we go above 105 before that time? Well, the answer is this one would fail because we said this order was to get out at expiration, okay? And we've got that gear in there, okay? This is a first triggers to OCO, first triggers OCO. So whichever one fills first, the other one will cancel here on them. That's what that first triggers OCO means, okay? So let me get out of this. Let me do this. And hold on one sec. It is not, okay. For that one, it wants me to do that. It's going to let me do that? Oh, come on. Okay, good till canceled. Okay, so what I'm going to just say is if Walmart is anything greater than $1, okay, effectively, that should do it. There we go. First triggers OCO order there. Okay, R1 says, does the mark mean that if the trade's at that value or it just gets bid asks? Okay, looks like, so the mark price is essentially the middle price there between the bid price and the ask price. There may not be any current trades at that mark value. Okay, that is true. So there's my trade. Okay, I'm going to put that in. And make sure you read this. Just read the notes there. Now, notice what I did, just in case you guys encountered this in the future, because I went through that a little quickly. Here's my buy order. Normally, if you put in one of these custom orders and you mark it GTC, it says, hey, a GTC order has to, not GTC, a market order has to be a day order. But once you put the rule in, our rule was over 105, then it says that's okay. You can still put that in. Okay? When I put in this other one and said, hey, I want to get out market good till canceled, it didn't like it initially because I didn't have a price on there. So what I did was I just said, there is a price in there. I'm just going to say as long as Walmart's above $1, which I'm pretty confident it will be at that point. I guess no guarantees. And that way we got past that little error message on there. Okay? All right. Hoping that makes sense. Let me hit another question here, and then I'm going to submit that. Now remember, short options can be assigned at any time before expiration. That's why we're getting out before expiration. All right. Now, so we entered that trade as well. There's a survey link in the chat. Did I pick this stock? I picked the stock because it's a double top. Okay. Yep, double top is exactly why I picked this as a bearish trade example. I wanted to give you a bearish example along with a bullish example. Okay, let's do one more. And then if we have time, I want to just look back on one of last week's trades. Let's look at Oracle because I wanted to give you an example of just how more expensive stocks can certainly act in this situation. But let's look at the technicals here on this for a sec. Oracle had been very bullish. We had this big gap up, and when we have a gap up, often people have a concern that it's going to pull back, and indeed it did pull back. At this point, my assumption is we've got some support right around there, okay? That's my assumption. This is support. Now, I may be wrong. It may break below that, but if we're doing a bullish trade here, what I'm going to say is I'm going to get out as soon as we break that support, okay? But my assumption is, hey, the general trend has been up. We had this kind of gap we've bounced off the support there on this, and my assumption is we're going to go bullish from here. Okay, so that's Oracle, and let's just kind of look at this as a possibility here. Let me go, I'll do analyze trade again. Let's go to Oracle. I'm going to go out a little bit further here. We'll go out again to the 17th here. Now, can I go out further? I can go out to 63 days, but just realize, for example, those are going to be pretty expensive here. If I'm just looking at, say, 2 in-the-money contracts at maybe the 280 strike, it's $3,200 for a single long contract on the 17th of October. If I go to the 38, instead of, what do we say, $1,700? Wait, no, $3,200, it's $3,800. So it does become more expensive on that. So, but if your forecast is longer and if you're longer term bullish on this, you can by all means go out and do the longer term contracts there on this. But I'm doing 2 of those, right? Well, let's see. I don't know if 280 is going to be the one. We'll have to see. I'm going to go at the money. Well, at the money. Well, again, we're kind of right in between that at the money and, so I'll go to the $300 strike. I'm going to sell the $300 strike. So I'm just going to click on that, the bid price. I'm going to go in the money. I'm not going to make the same mistake I did on Walmart. To try and make this a zebra, I'm going to try and make this 2 times. Well, I'm going to go to the 270, I think, here on this. Okay. I'm going to buy 2 of those. It's going to be more expensive. Hold down my control key. There is our trade. And let's just right click. Let's just look at what it looks like. Here we go. 21st of November. Let me go to November 22nd here on this example trade for a zebra. And let me set my slices to break even. And there we go. Again, there's our break even. There's our break even, and there's the current price. Pretty much the same thing, almost, pretty close. That's because we did a zebra trade on that. We matched that 0 extrinsic value. Now, notice if I change that up and I said, oh, hey, look, instead of the 270, I did the 285. It's not even traded. We'll go to the 280. I think what we're going to see is a bigger difference there in the 2. Let me set my slices, break even. Okay, and the current price is there. You see how the gap is bigger? Okay, you see how there's a bigger gap between the current price and the break even if we don't do the zebra on that. Okay, if we do not do the zebra on that. So that's the trade. And then we said, I think originally, let me go bring it back to where we were before. It's going to be 270. I'm not actually going to place this trade right now, but if you want in your paper money, I encourage you to place paper money trades, paper money, just for example purposes and practice purposes. But let's see. Okay, so I want to look, because I'm running out of time. I want to look at last week's trade and just answer another question. By the way, survey link in the chat. Last week we did a trade, and it's an example of one where it went totally against us, okay? And it's an example of, we did it on UNH. We did a synthetic last week, okay? Before we get too far with that synthetic, you can see it's gone way against us. But difference between a call back ratio spread and a long synthetic plus a protective put. Okay. Well, let's see. callback rate spread and a long synthetic. So in the case, you know what? Off the top of my head, I'd have to compare them side by side on the Analyze tab here on that, Chris, to see the differences. I'd probably encourage you guys to do so. I'm trying to think because I'm a little pressed for time here on some of the differences between a call synthetic and with a protective put. So this is, well, let's start here with the call synthetic here, okay? Here's the long synthetic we did last week. This one went totally against us, right? Now, one of the choices we had was buying 100 shares of stock, okay? It's an expensive stock, okay? The stock's a $338 stock. We bought this on the 12th. Okay, so let's look UNH on the 12th here. UNH on the 12th, is this the 12th? Where's the 12th? There's the 12th. We bought it here and it went down. And you may go, well, it didn't go down that far against us, but keep in mind, we bought 100 shares of stock on this. No, we didn't buy 100 shares of stock, but that was the choice. That was what we were kind of mimicking. And if we bought it up here at about the 357 level and we're down at about, we've dropped about $20 on the stock, roughly, okay? The purpose of the synthetic was to mimic the stock. So even though it didn't cost us much, and you may be going, well, it didn't cost us much, but we're down almost $1,500 on this, that's how much we would be down, approximately at least, if we bought the stock, okay? So this shows you can kind of get similar movement off the synthetic option trade, the long stock synthetic, using the options as you can with much less cost. But this also shows you the risk of that, because we can get in this mentality of it's a cheap trade, but it can go against you in a big, big way. Now, should we get out of this trade? Well, what I would say is, why'd we get in it? We still have a lot of time to go. Why'd we get in it? We got in it because we were bullish on this. Am I still bullish on this? Are you still bullish? If the answer is no, then you would probably just get out at this point. I do have a stop on this, okay? And the stop doesn't guarantee anything. The stock could gap way down and we could be in trouble with that. But we do have a stop to get us out. And at this point, I'm not willing to give up on this trade and say it's bearish. We had a little bearish move, but the general trend is still hanging in there. And that stop we had is if it goes below 310. So we still have a little ways to go on that. That's what the synthetic is. Now, I'm not going to totally answer your question, Chris, because I didn't have to think that through a little bit more. But for those of you watching, I mentioned synthetic. You could do a long put here as a protective put to try and help protect you on the downside on that trade there, okay? And I would just have to see, but keep in mind, let's see, if we're doing that put there, that's adding some extra time decay into the process there as well. Yeah, there'd be fairly similar trades to be honest there on that. We'd have to look at it a little closer on the Analyze tab. Okay, I'm hoping that helps. Hoping that helps everybody. Those are 3 example zebra trades for you today. Hoping you like those. Practice along in Paper Money. Make sure you follow Cam on X. Cam has an interesting post today on X, by the way. You can follow me on X as well. At Brent Moore CS. At Cameron May CS. Those are the X handles. Thank you for joining me, everybody. I'm out of my time. Coming up next, we've got ThinkScript Studies. That's coming up at the top of the hour. Hope you all have a wonderful weekend ahead, and we will see you all same time next week. Bye-bye, everybody.